Hi everyone, hope you're all doing well. Today I'm doing the UK stocks I'm buying July 2024 edition. So this is where I go through all the moves that I'm making in my UK portfolio between the 1st of June to the 1st of July. So I've done this series for many years now and it just keeps up that transparency so you know every move I have made. If I've made any moves in the stock market, they always appear on this video here so you can track along with how I'm doing in the stock market. This is very different from a lot of other YouTubers out here that don't do this, that potentially buy something and then it doesn't work out and they sell it quietly in the background and hope you never notice, or potentially they buy something and they only ever mention it if it's gone up a lot. We do things different around here, so if anything works out, you'll know about it. If anything doesn't work out, you'll also know about it. But apart from that, let's get stuck onto the UK stocks I'm buying July 2024 edition. Just a quick plug here though, if you do want to join the Patreon, join through the link in the description. It's only £5 a month and you get to see 2 exclusive videos a week on there. You get to know what I'm buying and selling in real time on there, and you also get a Discord with 500 members on to talk about stocks, including me as well. Not bad for £5, the price of a pint. You support the channel and you get to see the exclusive video like this one here, which is my UK portfolio, and you get to see every position in there, how everything is up, how everything is down, the allocation into the position sizes in there. So if you do want to join that, support the channel, it's £5 a month, guys. It is the highest YouTube subscriber to Patreon ratio out there on the YouTube channel because I do try to put a lot of work into it. So if you do want to support the channel, join through the link. And as well as that, if you want some free shares, join Trading 212 with the link in the description. That's personally the broker that I use for my investing. And if you join through that link, you can get a free share worth up to £100. So starting off with the first stock, I think there's 6 stocks that I bought, and I think there was 1 stock I sold, which I'll reveal towards the end of the video. Well, I didn't sell it all, I trimmed the position. But getting on to number 1. Number 1 is Card Factory. I did buy some more shares in Card Factory. I thought the results they recently brought out were absolutely amazing. I looked at the share price, only up 10% in the last year. Year to date, it's actually down 4%. And I just thought this company keeps financially performing amazing, yet it's not reflected on the share price. Now, Card Factory has these kind of periods where it goes flat for a while, and then we have that big jump, and then it goes flat for a while, and then we go have a big jump. I think we are due a third jump in Card Factory sometime soon. I've had the stock now for around about 4 years, and I have, from where I first started buying, I'm up about 170% on the shares that I originally started buying, but I keep buying more and more because I look at the stock and going, you know what, I'm still seeing over 100% upside in the stock at the moment, I'm going to keep buying. Now the company does trade at 6 times earnings. I personally think that this company should be trading more towards 12, 13 times earnings, and that's without factoring any of the growth in. And also they do pay a dividend, which Google is not picking up at the moment, which I think is around about a 4% dividend yield, which is also really nice to collect while you're waiting for that jump in the share price to happen. But Card Factory, if you're from the UK, I'm sure you know what Card Factory is. They sell a lot of the greetings cards, but they have moved a lot more into like personal cards. They also do gifts, which is a massive area that's growing for them a little bit more. If you ever go into a Card Factory at the moment, you'll notice they have a lot more gifts around the checkout. So they're hoping that you buy a card, which is what, 99p, or because of inflation, £1.20 now. And then hopefully the basket you're buying gets a little bit higher as you buy these gifts as well when you go out. So you think, oh, you know what? I haven't got a present yet, and they're selling this chocolate over here. They like chocolate, you go buy the chocolate there. So that's also one thing that they're also trying to do. The other thing they're trying to do is that they have also done a lot of expansions. So they've done a long-term partnership with like the likes of Matalan. They've also expanded into new regions, like the Middle East, for example. And since the new CEO came in, which was Darcy Wilson, I think he's done an absolute fantastic job. He came in at 2020. The stock previous to that, the company previous to that was absolutely struggling. They were paying a dividend they could not afford. They were having a lot of competition. They were not focusing on what they were doing well. They were getting hit by a lot of wage increases. And the company, it grew okay, but the profitability was not moving in the right direction. Now, under Darcy Wilson, the profitability is ramped up, the revenue is ramped up. They're not having to pay a dividend that's too expensive for them. That's led them to really strengthening the balance sheet. The balance sheet was getting a little bit ugly, and you can see here they've brought the balance sheet back down to 14% debt to equity, which is really good. Potential to hike up the dividend even more. And as well as that, insiders are also buying the shares, which also gives you, you can see here the CFO on the 24th of June did pick up a good chunk of shares, around about 126k worth. Actually, sorry, Darcy Wilson, the CEO and the CFO, both bought some shares, which is really good to see. That's currently at the share price it is at right now. So you got some insider buying as well, just to kind of give you that bit of boost there. Really good business that's really turned around since the CV situation. Really helped it kind of like focus on what they need to do and what they were doing wrong. And for me, this is a turnaround play that I've had success on, and I still think I'm going to have a lot of success on with the partnerships that they're doing at the moment. Number 2 is Watches of Switzerland Group. So this is a new turnaround play. So we talked about Card Factory. That was a stock that was financially not doing well. Thought there was the signs that they're going to turn it around, and they did turn it around, and I think they still will turn it around. Watches of Switzerland is another stock that has financially gone terrible in the last few months. There's no other way to put it, but I believe they can turn it around, and I think we are starting to see the signs here. A stock that really did boom during the whole CV situation was a 4Xer, as you can see here, but since 2022 the stock was down 71%, and if you take off the recent rally, it was actually down 76%. 992 million market cap, 16 times earnings at the moment for Watches of Switzerland. Now, if you look at Watches of Switzerland, I'm sure most of you guys are aware they sell high-end watches and jewellery. One of the big things they sell is Rolex. Rolex obviously does not sell direct to consumer, so this is probably the best way that you could probably own Rolex, with it not being a public company and also not being a direct to consumer. Now, what happened in 2022, basically, or 2021, is everyone had all this free cash from COVID. Everybody was sat at home, interest rates were really low, and everyone went out and bought all these high-end watches, and we saw the big boom here. Now, 2022, we had all the pressure on with the economy, inflation, higher interest rates. People stopped buying those luxury watches, and we have had that kind of big pullback to normality now. And I think what we'll see now is the normal kind of uptrend that what luxury watches tend to have, and Rolex watches tend to have, where they have that natural trend up in value and that normality of spending coming back. And I think that we've had a big boom, we've had the reality check, and now I think we've stabilised at the right point, and I think the share price has gone a little bit too low for a quality company like Watches of Switzerland. An example of that is if you look at the index here for Rolex Market Index, you can see the big boom that we had during 2020, and you can see what looks like to me to be a little bit of a U-shape forming, and especially in the last kind of couple of months, it definitely seems to be putting a bit of a bottom in here for me as we start to get to prices that were around about February 2021, so we've not gone all the way back. We've certainly given it a fair way back, but what you'll see here is the historic uptrend that Rolex watches do tend to go on as they do gain value. Now, the big thing that Watches of Switzerland are going to do is they have good presence in the UK, but they've decided to expand into the US. US, I think, is a big market for them. I think obviously there's a bigger economy, big locations to go for, and this is why I bought the company, is because of the US growth. The US growth, as you can see here, has a history of where the doors have been opening up. The revenue growth, which in financial year 24 still grew 11% in what was a very weak environment, is the very strong part of the business. And this has just only now crossed around about 50% of the business. So the more this makes up the bigger part of the business and the growth there, I think we see Watches of Switzerland growing high single digit, which would be very attractive for the business, and there's a lot of room for it to carry on growing. Now, if you do look at the recent update on the 27th of June suggests that the company was back moving in the right direction once again. There was that recovery going on in the UK, especially in the US, going at really good growth. And the long-term guidance with this US growth and opening more stores is that they're going to, from their long-range plan, as you can see here, is the double of sales and profit by 2028. If they get anywhere close to that with this US growth, then this company will do very well. I've got a bigger deep dive on Watches of Switzerland on the YouTube video, on the YouTube channel, if you do want to go watch it. I'm cautious, I only spoke about this one around about 2 weeks ago, so I'm going to keep it a little bit briefer than what I did on that video there, but if it does sound interesting, then go give it a watch. You can see here though, the profitability had that little bit of a drop with the slowdown, but if we do go back to good growth and the profitability ramping up, and we do about 100 million profitability, I think that's quite attractive for the business. Balance sheet wise, it's not too bad on the balance sheet at the moment. Ownership wise, what you'd like to see is insiders buying on the drop, and you have got the insiders buying on the drop, and you've got all those kind of key roles like the chairman of the board that you'd want to see probably picking up shares, the CFO that's picking up a lot of shares. So yeah, that's positive as well. So I am liking Watches of Switzerland at the moment. The next stock on the list is Cakebox. So I think I made you aware of this when I did a review of their recent trading update on the YouTube channel. And I said, I'm really thinking about buying more shares. Well, I did go buy more shares, as you can see here. In the last year, it is up 19%. Year to date, it's up 11%. I feel like, though, the company still has a bit of upside here. I think 16 times earnings is maybe a little bit cheap for this company, as well as that you're picking up nearly a 5% dividend yield on this company at the moment, which is very nice. So, if you're going to get an average return of 9% to match the S&P 500, with a 5% dividend yield, you only technically really need a 4% share price increase, which I think can easily come at this valuation and the growth that Cakebox is currently doing. Now, Cakebox itself is a retailer of birthday cakes. Birthday cakes, even in recessions, people go out and buy birthday cakes for the kids, the family, and even in this big inflationary impact and recessionary environment in the UK that we've had, it's clear that people have still been doing that, and in this environment they're still doing very well. As well as that, they have actually launched their new membership, which I thought I took a screenshot of, but I haven't. But they have actually launched their new membership, which is good as well. Kind of has that membership like a loyalty program, like a Starbucks, for example. Is that if you keep getting, there we go, it is there. Join our cake club here, as you can see it, and if you start buying people birthday cakes, and you get reminders for it, and also you buy everyone's in your family's birthday cake from Cakebox a year, 4 or 5 cakes a year. That'd be a really nice earner for Cakebox. So it's good that they've kind of like been tapping into that loyalty thing that they've just launched in the last kind of couple of weeks, which is a really good bonus. But obviously they've got these Cakebox stores which are in a lot of locations in the UK. They still have a lot of locations to expand to though. I don't think there's many in Wales, Scotland, Northern Ireland. So there's a lot of room for expansion still with the business here. But I really like the kiosks. You might see some of the kiosks. This is actually what first got me interested in Cakebox. I first saw one of these kiosks in the Trafford Centre around about 2020. And I was like, oh, look at the queue for this. Like, people queuing up massively for it. And I had one, I was like, this is actually really good. And then I realised they're a public company, and I was like, oh, okay, this might be one that goes on the YouTube videos. And I feel like there's a lot of potential potentially to open up more of these kiosks as well, which obviously are cheaper to run, and you can put in really high footfall locations. But the recent earnings was the big thing that pushed me to go up and buy some more. The revenue was up 8.7%, gross profit 16%, EBITDA 15%, final dividend up 10%, earnings per share. Every single number with this business in the last update was absolutely amazing. And yet you pick at a company here which has 16 times earnings and 5% dividend yield basically. I was like, yep, go on then, I'll have more shares of this one. And I thought, I'm going to buy some more shares in Cakebox, and that's what I did. Same again with Cakebox. Nice history of growing that revenue and profitability. Financial health wise as well, very, very strong balance sheet. They sit on 5% debt to equity. Cash wise, they sit on 8.4 million as well, so really healthy on the cash side of it as well. Ownership wise, has actually recently been an insider buyer. So on the 26th of June, Suk Shamdel, the CEO and the founder of the business, he actually bought some more shares in the business. He bought 87k worth of shares, which is obviously once again a really good sign. Bought a £1.74, which I do believe is a little bit lower than where it is right now, but not much. So that was another positive that I saw here with Cakebox as well. Next one, Warpaint. So I did buy some more shares into Warpaint, and this has come in a pretty big position quite quickly. I tried to take a bit more of an aggressive approach with this one because I should have bought this a long time ago. You guys might know I used to own Revolution Beauty. My plan was to sell Revolution Beauty and put it in Warpaint. I never did that, and then because of that I missed out on a 100% return on that one. But then I re-looked into the numbers, looked at the financials and went, you know what, even though I've missed out on this, I still think I can make money on it. So I went and bought some more shares into Warpaint. I am up around about 19% on this position since I did buy, because it has had a pretty decent month in the last kind of couple of weeks. I did really buy it like the start of June, and it has done really well. 33 times earnings, you do pick up a nice dividend yield on this one. Most of the company's revenue comes from the W7 brand, which is supposed to be a bit of a premium feel to it, but a cheaper price. And you can see these probably sold in like the likes of Boots, for example, if you're going to Superdrug, and also expanding internationally into the US very aggressively as well. Same again, I don't want to keep you too long on this one because I did a video 3 weeks ago talking about buying Warpaint, which was around about a 12-minute video, and we'll sum the reasons why I bought it into a lot more detail and a lot more better than what I do right now in this video, because there's so many stocks I kind of try to keep it to a 4-minute, 5-minute for each stock. That one obviously will break it down into a lot more detail, but just a couple of points that video summed it up better than what I can do here, so I am actually going to use that video very quickly. But these are the kind of brands that they own, and they obviously sell affordable but good quality businesses, products here. They just came off a cracking year in 2023, revenue up 40%, gross margin up 350 basis points, profit before tax up 135% year over year. This is the growth in UK. Europe is a massive, the US is a massive growth driver, rest of the world is a massive growth driver. So they've got a good footprint in the UK, but now they're copying and pasting that into like Europe and US with the products. And the US is a lot bigger market than the UK, so if they can do what they've done in the UK, which is a 1.8 billion industry, do it in the US, that's an 18 billion industry, and they should do pretty well from the US kind of growth. And they've done that by landing big clients like, you know, Walmart and Macy's and CVS over in the US. And the last trading update was also pretty strong for the business. If you do look at the company, they've got a very good track record of delivering very good growth on the revenue, good track record of the profitability. The only time that we saw a bit of a dip was during the whole COVID situation, as there was a lot less, you know, traffic into the stores. Apart from that, you know, easily recovered financially. Balance sheet wise, good balance sheet. They sit on no debt to equity, as you can see here. So there's no debt on the balance sheet. Sit on 9 million of cash here. And on the insider front, there was a sell from the CEO, so that's just something that I'm going to point out here. Normally I point out the buying, but I think it's fair to point out some selling. The CEO did sell a good amount of shares, but saying that, with the gains that he's probably sitting on, I don't really blame him for kind of releasing some capital here from the business. But what I will say is that the founder, the CEO of the company, does still own, is one of the largest, is the largest shareholder in the business. So I think that's still okay at the moment. So I'm happy with that one anyway. The next one is Yugo. So I did buy some Yugo. I did actually buy a little bit before the drop, and then I bought a lot after the drop. I was giving this a good think over. If I sell my Yugo shares, if I buy some Yugo shares, do I sit on it? And eventually I thought, you know what, I'm going to buy some Yugo shares on this dip. Now I'm not going to chase this stock. I bought and that's it. Now I'm going to sit back and see if they do recover from here. I think I'm down around about 30% on the position right now with Yugo after this drop. So they did come out with a profit warning. The profit warning basically said they have seen slower sales at the moment. They said that they're going to downgrade the revenue, downgrade the profitability, which is not good to see. Now, Yugo obviously is a research site, so maybe companies are just pulling back the research at the moment. You know, recession fears coming in. We've seen a lot of companies at the moment, you know, reporting bad earnings. We've seen the jobs side of it getting a little bit weaker at the moment. So maybe they're just getting impacted by the whole environment at the moment, and eventually, you know, a lot of these costs that they've put in place will start getting the investments that they've made start getting the rewards, like the expansion into Eastern Europe, the acquisitions they've made, and also the investment they put into the platform. And if they do get near their medium-term guidance, which is 650 million revenue with operating profit margins of 25%, I think Yugo will look very cheap from here. The only little situation we have is how they kind of get there, and that's when you buy Yugo, that's what you got to kind of work out. Are they going to get to what they say they're going to do? At the moment, the growth was very good, but you can see the dip in the profitability that's going on at the moment. Hopefully, they do start recovering that back towards next year and the year after, and if they do start doing them numbers that analysts are forecasting, it'd be very good for Yugo. But it's if they're going to get there, we'll see. Financial health-wise, the only thing that I don't like about Yugo is that they've recently taken a lot of debt on for an acquisition. The acquisition hopefully will pay them back, and they'll be able to pay that balance sheet back a little bit and sort it out. That's the other thing that does put me off. But what has happened on this dip is we have seen some insiders buying some shares. We've had the CEO buy some shares, the chairman of the board bought some shares, which is what we want to see. It gives you a little bit of confidence that, you know, if they're willing to put some money into the stock, then potentially are they seeing that they think that this is a good share price, and maybe the fear is a bit too much, and maybe this is the bottom financially and the business starts turning around. We'll see what happens there. So I did buy some Yugo. And the last stock that I bought on this month was Legal & General. The stock had a bit of a tough month. If I do zoom out a little bit here, you can see, since really about the 5th of June, the stock fell around about 10%, which is a pretty big dip for someone like Legal & General. It has had a bit of a bounce back since then. 8% dividend yield as well, which is the main reason why I buy it. Basically, you get a market average return of the S&P 500 in just holding this stock. And then if they do get some share price appreciation as well, that's where potentially you do very well from this stock. Overall, there's a lot of insiders buying the company at the moment, as you can see here. There's been a lot really over the last kind of couple of months and weeks, which is really nice to see. And hopefully with a little bit more stability in the UK economy, maybe the UK housing market comes back as well, we'll see Legal & General recover, and that profitability ramps up, and they just carry on the history of hiking up that dividend, which they have done over the last kind of few years. And that's all the stocks that I bought, and that leads me on to the last bit, which is the selling side of it. So I did sell a 5% trim on a stock that I own in the UK portfolio, which was Supreme. So I haven't sold it all. Don't panic. Sometimes people don't realise that I've said that I've trimmed it. I still own a lot of Supreme. I still think it will do very well. That's why I own still a big chunk of it. I just sold 5% of my position off. The reason why is just that the stock's gone out absolutely bonkers. That's no way to put it. Year to date, one of my probably best performing stocks in the UK portfolio at the moment, up 64%. In the last year, up 59%. And I just thought, you know what, I'm going to take some profit off the table here. Sometimes I see that, there's a few things here, probably 3 points. First one being is that sometimes I see some of these stocks go absolutely crazy, big movements, and then we have a pullback and people are like, oh, I wish I sold some shares. Well, at the end of the day, we're all here to make money. I've seen it before where stocks go up a lot and people don't take any profit off the table. It has a big pullback, some news comes out they don't expect, and they go from being up on this position massively, and they wish they had took some profit off the table and it all goes wrong. I've seen it happen a lot. I've seen it happen a lot where these stocks go up a lot and you think you're top of the world, and then very quickly things go absolutely wrong. Because, the bulls take the stairs, the bears take the elevator, and when something does go wrong with business, it just falls off a cliff. It takes months and years to get these gains, and then sometimes it just falls off, and it's horrible. And for me, that's the big thing, is we're here to make money. I'm making some money, bit of protection. If anything goes wrong, I took the profit off the table. So that's one thing that kind of came into my head. The other thing is that just the risk of vaping. We all know there's the risk of vaping and regulation on the vaping industry here with something like a Supreme. And even though we know about it, just that if there was any kind of news that came out that, there's more regulation coming, without doubt Supreme would lose 20-30% in one day because of that. I don't think there is anything that we can't see at the moment, but that's obviously, we can't see it, and that's why when it comes out it's a shock and the stock falls. So if there's any sort of any regulation that comes out, 20-30% will be wiped off easy, and I wish I took some profit. So that was the kind of another reason. And the third reason is just to have some bit more cash. I think that we are at an interesting time at the moment. It's probably worth a video at some point. I think there's a lot of opportunities out there, but at the same time, I think there's a little bit of nerves out there. We've not seen the Fed cut the interest rates, which we thought we would. We're not seeing the Bank of England cut their interest rates when we thought they would, and they probably both should do. We're seeing weaker data coming out. We're seeing the likes of the job data getting a little bit weaker. Just the cash pile is really good. And another thing personally as well is that I would really like to buy another investment property at some point this year, if not early next year. So for me personally, if I'm going to do that, I need not a little bit of cash, I need a lot of cash, and maybe that helps me on the way as well. So there's just a few things between stocks running up. Let's make, we're here to make money. So, if you do make some money, be happy about it. Just, managing that regulation risk, and also personally for me, a little bit of a cash pile, and what I think is right for me at the moment anyway. So yeah, I did take a little bit of profit of Supreme, which has been a really good performer for us this year. So those are the 6 stocks that I bought in the last kind of couple of weeks, and also the one stock that I did sell. Well, I trimmed the position, was Supreme anyway. So hope you enjoyed the video, guys. If you could hit the like button, if you're new around here, subscribe if you found it helpful, and I'll see you all in a bit.